When most investors receive a pro forma, they start reading it from top to bottom. I don't. In the first 60 seconds, I'm usually looking at just a few numbers because those numbers tell me whether the deal deserves deeper analysis or immediate rejection. In this video, I want to show you exactly how I approach a pro forma in the first minute. Not every line, just a few numbers that determine whether the investment actually works. If you're new here, I'm Darren from DK Wealth and Growth. And if you've been following along, you know this channel focuses on disciplined multifamily investing, especially CMHC-eligible opportunities in markets like Alberta. But today isn't about a deal, it's about how to evaluate one. The first number I usually look at is the vacancy assumption. Developers often assume very low vacancy rates in their pro formas, sometimes 3% or even lower. But the real question is not what vacancy is today. The question is what happens if vacancy rises. If the deal only works with near perfect occupancy, that's a warning sign. Strong investments survive realistic vacancy assumptions, not ideal ones. Next, I look at the projected rents. Developers often base their pro formas on top of market rents. That's not automatically wrong, but it needs to match reality. So I compare those numbers to market comparables, what similar units are actually renting for right now. If projected rents are noticeably higher than the real market, the deal deserves a closer look because optimism tends to concentrate right here. Then I look at net operating income, or NOI. This is where small assumptions about expenses start to matter. Operating costs that are underestimated can quietly inflate the NOI, and if NOI is overstated, every downstream number becomes unreliable. So I'm looking for whether the income and expense assumptions actually reflect how the building will operate in the real world. Finally, I look at the debt service. This is the same number we discussed last week when we talked about debt service coverage ratio. The key question is simple. Does the property's income comfortably support the debt? If the margin is thin under realistic assumptions, the investment becomes fragile, and fragile deals are exactly the ones disciplined investors avoid. Here's the key insight. Reading a pro forma isn't about reviewing every number. It's about identifying the load-bearing numbers, the assumptions that hold the entire deal together. Vacancy, rent levels, operating costs, debt coverage. If those assumptions hold, the deal might work. If they don't, everything else becomes irrelevant. This is why experienced investors treat pro formas differently. They don't read them as predictions. They read them as scenarios. The job isn't to accept the numbers, it's to stress test them. If this kind of disciplined approach to evaluating multifamily deals resonates with you, make sure you subscribe to the channel. Each week I break down how serious investors analyze CMHC-eligible opportunities and what's actually happening in the market. And if you'd like to explore the multifamily projects that pass the filters we talk about here, you'll find links below where you can join the investor list or learn more. Thanks for watching, and I'll see you in the next video.